So, welcome, ladies and gentlemen, to FOMC. Yes, I used to have hair, now I don't. And I used to speak properly, now I don't. I've just got a sore throat, but never mind. So, most of you have been like, yeah, man, we like this really deep voice that you've got. Yeah, it's not great. Trust me, it's not. I'm normally used to shouting at you all, but I've got to tone it back. Welcome to tonight's FOMC. It's the last one, it looks like. We ain't going to get any FOMC from Jerome Powell anymore. Polymarket are not going to have the bets on whether he starts off the FOMC with good afternoon. Could you imagine he actually says something different? That would then definitely tell me that he has some involvement in betting against the idea of saying good afternoon. It's like, what, they betting it's nearly over $500,000 marketplace, man. That's a good place to put a little bet. Anyways, so I look better yet because I've shaved the head. That's why. I got the clippers done. We got to look sharp. How we feel is a different story. But anyways, let's get to it. A lot of wait and see mode is kicking in. Just right now, before I went live, US seizes an oil tanker off the coast of Venezuela. So that's not really going to make things interesting, isn't it? I mean, we're trying to do FOMC. We don't want another war kicking off. But that has sent oil's price up a little bit, up to around the $58 mark. Yeah, crude oil's trading at $58.37 now. So it's getting quite interesting to say that just right now, they tell us that they've seized that oil. They could have waited a little bit, but never mind. What's the plan this evening, guys? So we're waiting for the idea of what Powell's going to reveal in the actual press conference. Most of what we're going to be hearing about is going to be portrayed in the FOMC projections and, of course, their expectations of where they think interest rates are going to be. This is a very important time for Forex, foreign exchange, because it's going to dictate where investors should be putting their money. If the expectation for yield in the future is going to be higher on the dollar because the Fed wants to keep interest rates to a minimum, or not so much minimum, but keep them high so that they can control inflation, then of course investors are going to go over to the dollar, okay? So once we get the minutes, everything's going to be coming out. The projection statement, that's going to reveal to us exactly where we can expect money to start moving from. Okay, that's the important bit. Once that comes out, which will be in the next 15 minutes, we'll have a half an hour until the actual FOMC press conference. During that time, I'm going to take some questions. Any coins or any assets that you want me to look at, I'm going to dive into them. I'm going to try my best to not speak too much, which is not going to be a standard FOMC now, is it? But I'm going to keep you guys in the post, in the news, in the wire, in the whatever. I'm just talking nonsense. Let's get with the program, ladies and gentlemen. Understand exactly what we're dealing with. I've got the XRP flu. Yes, I do have the XRP flu. That's why I say to you, don't buy. Anyways, let's get with the program. Here we go, guys. So, wait and see mode. Why are they even wait and see? Well, we spoke about it earlier on when we were talking about the idea that everybody knows we're going to get a rate cut, which is interesting at how it's not been pushed up even more. Like, surely we're getting a rate cut, yeah? These guys have an expectation that they think they're not going to cut. Could you imagine if the Fed doesn't cut right now? Oh, my days. Ladies and gentlemen, that'll be a great time to start shopping for assets. Believe me, it will be a great time because the market will slump. It really will. Yes, XRP flu, I understand. Yes, cool. You funny guys. It looks like the Aedes sickness. Oh, God. Should I sell XRP? My back test, I'm reading the wrong things. Guys, you put something in that, then I'm probably going to read it. So never mind. Anyways, so a lot of it is just wait and see. They're all starting to say that even though the Fed is going to cut, we've got some situation that we need to pay attention. That not many people are paying attention to it. And I spoke about it this morning. The bonds. No one's paying attention to the bonds. The bonds are the truest identification of where investor sentiment is at. Look at it. 2-year yield is pulling back, but it's been going up. Okay, forget this pullback, right? They've been marking higher. 5-year, marking up. 10-year, up. 30-year, up. What does that mean? It means the expectation of rates in the future is going to be higher, right? So even though we're looking for the bonds to climb up, because if the bonds climb up, it means investors are happy to take on the risk. The only way that they won't go up is if the Fed does decide to change its post on inflation. I think they are not going to touch it. They're going to say, yep, we're sticking with 2%. if they give any inkling that they might go to the idea that inflation may stay at 2.53%, it's a catastrophic event. Everyone across the seas will be like, nope, we're not interested in US debt. That will send the yields higher. That will send the stock market down. And we don't want that, ladies and gentlemen. Going over into other assets across the board to understand where we are with everything. Dixie. Dollar dominance has made a little bit of a pullback, ladies and gentlemen. Just going over into the daily time frame to put things into perspective. What I'm doing now for anyone that is new is we're going over to assets that are going to have an impact on what this FOMC is going to be about. The rate of interest, the rate or the cost of money, the cost of doing business, right? As it stands, you can see that the dollar dominance has now come back into a very significant area. And it hasn't quite tested these 90 levels, but these are really crazy levels for dollar to be at. But they seem to be consolidating very well inside of this range. Now, from a patterns perspective, we would make the assumption that this could be a lovely little W formation on the dollar to try and climb up, because the dollar will start to reign supreme. It will start going up again. It will most definitely start going up, because if dollar's going to be cheaper, then more people are going to transact on it. Look at the yen. Why does the yen go up? Speaking of which, the yen itself is trading from and away from these lows, very significant level right now. Okay. And that being said, going over into dollar yen itself, just understand where we are. That's still trading at very significant zones as well. Just get rid of that. You can see it's consistent with Forex intervention. My expectation is that we're going to see dollar yen come back up and claim this area at 161. I'm expecting the 161 for dollar yen. So you guys just sit tight and enjoy that. USD CAD is pulling back a little bit right now, but it's not doing too badly, to be honest with you. It's doing just a little bit of a pullback after being climbing for so long. And then we're going over into dollar Swiss itself, safe havens, the Swiss dollar and whatnot. Sorry, Swiss franc. So you can see they're consolidating, and it's all going to be based on what happens with this FOMC rate cut, because they're going to tell us where we're going to be in the future. Okay. Now, Bitcoin, let's see what Bitcoin's up to. It's doing a very good job of holding at these lows. We've got a wickless candle down here, which is a bit of a problem for me. But you can see that Bitcoin's been a bit trying today. I mean, how many of you traded? Not so well. I'm all good, man. I feel absolutely battered, ladies and gentlemen. There's no lie. No lie. I'm absolutely exhausted. But never mind. Yeah, look, listen. I've got the tea. Don't get twisted. We've got the tea. We're waiting for Jerome Powell to drop the flavor so I can just stay quiet for a few minutes. Powell decided no cuts today. Don't be silly. Tina, my dad requires your help. He's hesitating in purchasing right now 10K of XRP or wait for the next cycle. Tell him to spend that 10K on a Caribbean cruise, all right? Or go to one of the finest brothels in the world, and at least he can enjoy himself. Because if he wants to get depressed and be miserable, then tell him to buy XRP. That is financial advice. Take that advice, ladies and gentlemen. You want to invest 10K, do not invest it in XRP. I mean, if it pumps right now, then come on, man. Like, it would only make sense. I mean, look at it. It's not gone anywhere. Never mind. Anyways, quickly going over into a couple of other things. We've got to pay attention to this. NASDAQ. NASDAQ has been right. Look at this volume. I need to stress this to you all, right? I've been playing this game for quite some time, okay? When I had hair, you didn't think I did because, I looked really young. Now that I've clipped all my hair, I look like I've aged with the markets. So that's all good. And I want to be taken a little bit seriously. With a head that has got a circumference of, or the definition of circle. Speaking of circle, it's doing all right. It's at a discount. But anyways, the market needs volume. We need money to put into the marketplace. Conviction. Bottom right of this screen, you don't see it. That's the problem we've got. You're at near enough all-time highs. No commitment from the market. This is what you call retail. This is what you call the dudes that are waiting in a coffee queue. Yo, man, did you buy that asset? What is it? Circle? Nah, man, I didn't get it. Did you buy Bitcoin? Nah, I didn't get it. Did you get NASDAQ? Nah, man, I didn't got it. I'll buy. Oh, I brought some. Yeah, man. We're at all-time high, bro. Okay, cool. Where are the fat boys? Where are the boys with the mullah? Where are they putting their money? Well, they wouldn't be putting it anywhere unless they knew if money was going to be expensive or not. Hence the rate cuts. That's what you've got to think about. There's only so much you can focus on when it comes to technical analysis. You'll look at technical analysis and say it went to the Fibonacci golden ratio because it went to the Fibonacci golden ratio. Okay, but tell me why? Because it went there. Why? Because everyone's trading that. Why? Well, why would everyone be trading towards that point? Well, there has to be something behind it. It's just because I've gone back in the charts and it told me that every time it always goes back to that point. Oh, okay, cool. That makes sense. Well, how about we add a little bit of context to that? Maybe that's where usually market makers, investment banks, hedge fund traders, their inventory resets at usually a midpoint, the mean reversion. All right. That's why you see it always get a bit choppy at the 61 or the 50% of a range. All right. Inventory resets, algo resets. All right. It's not because he went to the Fibonacci, because the Fibonacci was a floating line that said, we are at the golden ratio. This is where price moves. Hell no. Bigger picture of things, what I'm trying to say to you guys is this. We are in a macro-driven environment, okay? When someone says something about the economy, the market goes up or down. That's macro-driven. You go back to when the interest rates were 0.25% on the dollar. Any bad news that came out was irrelevant. It just kept on going up. Why? Because whatever the bad news was, it didn't affect the fact that the money was still cheap, so I can still put it to work. I can borrow it and short the asset, all right? Right now, you've got money that's expensive, which means that how much am I going to pay to short this when there's no guarantee that it's going to work? You understand? So when you understand that it's the cost of doing business, it's going to determine whether the business is going to continue, then okay. No volume, nothing. Volume at the bottom here tells you that the stock market is in the expectation that there is overvaluations. The problem is the economy is not giving anyone the concern. So the soft landing idea is coming into play. If the economy is only pulled back a little bit in line with what the Fed is expecting, then they have no reason to cut the rates. Even though we're getting a rate cut, the fact is that, are we going to get any more? And that's what we're looking for in tonight's FOMC, right? Cool. Anyways. See, Bitcoin dominance is collapsing. Okay, cool. It's true alt season around the corner. Are you still on that? Where's alt season? Let's have a look at altcoin season. Let's have a look at altcoin season. What season are you talking about, bro? Alt season's around the corner at 33. Okay. Buy your altcoins, ladies and gentlemen, because it's around the corner. People that are in altcoins, waiting for altcoin season, are the type of people that are going to look out and be like, is the weather changing? Maybe altcoin season's coming. Let's get with the flavor, ladies and gentlemen. If Bitcoin goes up, everything goes up. Simple as. That's it. But just take something off the table. Everyone is holding on to the bag to break. Be honest now. How many of you are holding onto your altcoin bags to achieve break even? Be honest with yourselves. Put it in. Do you guys hold onto your altcoins and be satisfied with the idea of breaking even? I'd love to know. I would love to know. Tino, is the Brinks box and past sessions are not to be considered during FOMC? Don't trade the FOMC, ladies and gentlemen. Don't. You've got so many times to trade the marketplace. Why do you want to trade now? Well, look what Bitcoin's doing. 5 minutes ago, we're in the bull market. Now, where are we? Yeah? Come on. I am. Nope. Yes. 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 See, some of you might not be, some of you will be. Okay, that's all good. I'm not saying that. I'm not saying that everyone in altcoins is losing. No. But when you see a common theme, all right, you got to understand, why aren't your altcoins going up? Because no one's putting money into them. Why wouldn't anyone be putting any money into them? Because you're about to sit and witness the FOMC press conference because we want to know if money's going to be cheaper or not. Go and have a look at the interest rates when all your altcoins went up. Okay? They were low. That's why altcoins went up. Yeah? Would you say that? Was everyone playing altcoins then? No, just people in cryptocurrency. But people in cryptocurrency had the access for cheap money. So the guys that were smart enough to take the cheap money then and put it into crypto are the ones that made a killing on the altcoins. Right? Then everyone else started to jump onto altcoins. But when money started to get expensive and you're all asking, why ain't my altcoin pumping? They've rinsed it. Hopefully altcoins do start to make a move up. But anyways, never mind. XRP to the moon, he says. Okay then. XRP to the moon. Stop winding me up. Anyways, guys, we're getting close to it. Close to the FOMC actual federal funds rate and the press projections. Okay, so I'm going to be reading those out to you whilst we're waiting for. Listen, my voice is just in the bin. All right, forget about my voice. But just to give you a quick update on everything, for those of you that are new, who is new here today? Who is new? If you are new, welcome to Traders Rally. My name is Tino. I used to have hair. Now I don't because I shaved it. That's all that is. You know, don't worry about anything else. I just shaved it off. Anyways, if you are new, make sure you check out tradersrally.com because I've updated the old masterclasses. Now they are whiteboard sessions. All right. So go check that out. It's for the platinum members only. So if you want to learn more about the hybrid, go check that out in the whiteboard session. All right. But you still get access to the old masterclasses. All right. But the second point also is you can trade BTCC now through TradingView. So if you don't want to trade on their platform, you can trade and execute through TradingView. All right. If you want to check that out, it's pinned to the top of it's in the description, but below the link, I've attached a watch list so that you can trade the assets directly from the watch list itself. So I've got the Tech 100 for NASDAQ, the Nikkei Index, the Dow Jones, and the S&P 500. That watch list is in the description of this live stream. So if you join BTCC, the link's there, and then you've got the watch list link, which is right in there with the description itself. Okay, cool. That's that right there. Now, let's get with the program and understand where we are going with Bitcoin. Let's have a look. Bitcoin's making a little bit of a move. Got some flavor on the spot order book right now down here. So that's going to be interesting. Where we at? There we go. There we go. What a guy. Here we go. US interest rate, actual decision, 25 basis points, previous 3.75. That's fine. We've got that. So let's just quickly go over to that. Let's have a look at where NASDAQ is and Bitcoin. Here we go. Bitcoin doing a nice little move right there, ladies and gentlemen. All right, now we're looking for it. Here we go. The actual median rate forecast was 3.625. All right, we're just waiting for some information. Nothing's coming in yet. Oh. Hassan's speaking. What's he said? Well, White House economic advisor. Stronger data could support 50 basis point cut. Okay, here we go. All right, this is usually the first move is the false move. Hopefully that's not the case. Remember, we've got a lot of traders that are trading the idea of rate cuts. All right, just quickly going over to gold. Have a look at where we are with gold. Gold's not moving, man. When gold does not pump on rate cuts, it means that they're looking for a bigger thing. Fed median projection maintains 25 basis points rate cut into 2026. We will consider the extent and timing of additional adjustments. Okay, they just pretty much told us we're not going to get cuts. If the expectation is Powell is getting replaced soon with a pro-cuts chair, is it possible the market won't care as much about the future guidance? Of course it will care about it. Most definitely. Now we're getting some movement in gold. Here we go. Wow, we will buy $40 billion of treasury bills over the next 30 days. So they're scared of liquidity. They need to put the market with liquidity. That's good news. Schmid and Goolsby dissent in favor of no rate change. Wow, this is going to be a good FOMC, gang. This is going to be a good FOMC. Powell is going to be asked a lot of questions about this. Gold's making a move. Bitcoin, see why you're rejecting. NASDAQ, where are you? Let's have a look at NASDAQ. And by the way, for anybody that is new, I go quite fast. I'm actually quite slow right now. So yeah, I'm just trying to take it easy. But now forget the 1 minute, man. If we see this movement on the 1 minute, on the 1 hour, then correct. Okay, we'll begin treasury purchases on the 12th of December. So the Fed is buying back. Why is it buying back? Because it needs to reduce this. The yields are too high. They have got $9 trillion worth of corporate debt that needs to be refinanced, and it's getting refinanced at these levels. It's going to squeeze them. So they need to start buying the bonds to bring the bond purchases down, the actual yields down. And if they start buying, that might get everybody else excited to do the same thing. And we're going to wait and see if that's going to be the case. Fed median projection shows rates at 3.1 by the end of 2028. Oh no. Really? Four Fed officials penciled in 2 quarter-point cuts for 2026. Okay, 2 quarter-point cuts. That's not good. because that means we're going to get 25 basis points, wait a few months, then get another. What the market wants, what the market wants is 50 basis point cut in one. 7 officials penciled in no rate cuts for 2026. Wow. Right, wait there. Let's have a look at the dot plot. Where is it? Where's my dot plot? Here we go. I just saw it. Dot plot chart. Here we go. Have they updated it yet? It's not been updated just yet. Not been updated. My God, 7 officials were saying for no rate cuts in 2026. That's not good, man. That is not good at all. Bitcoin is so boring. Well, okay. Told you crypto might dump. All right, it might. Yeah, but we're getting the information, man. All right, okay, then Federal Reserve trims its interest rates to 3.5, 3.7. Okay, so this is the important thing that you've got to understand right now. As it says, keep an eye on Bitcoin. It says here, 7 officials penciled in no rate cuts for 2026, all right? So that's quite a few participants that have favored no cuts for 2026. However, it's saying that 4 officials penciled in 2 quarter-point cuts for 2026. So it goes to show that there's effectively mutiny on the bounty per se. They're not all in agreement with the rate cuts. And this is what Powell is going to be questioned about. And if there is inconsistency amongst the Fed members, then what do you think the market's going to be feeling like? That means that the path is not clear. So basically, the idea is now that investors might start triggering the logic of, is the market overvalued? You know what? If they don't know where we are with the interest rates and they think by 2028, we're going to be at 3.1%. Well, we're already at 3.75, 3.5, 3.75. That's where we are now. Only jumped down another 25, 30 basis points. Okay, 40 basis points. And we're at 3.1. That's from now till 2028. So we've got another 2 more years, nearly 3 years, 2 more years of the rates being between 3.5, 3.75 with 2 rate cuts to bring it down to 3.5, 3.5, and then 3.25. What the hell is that? That's where your correction is going to come into play. This is telling them where the rates of interest are going to be at. And this is what we need. FOMC is in 25 minutes. I know I talk like a World War II vet. Are you John Wayne? Who said that? Here we go. Vote in favor of policy decision was 9-3, with Mirren preferring, that's Donald Trump's boy, a 0.5 percentage point cut, and Goolsby and Schmid. How do you make it into finance with a name like that? Schmid. What's your name? Steve. What's your second name? Schmid. Schmid preferring no cut. What is that? They should all be aligned with each other. Fed forecasts for the economy seem to have a hawkish tilt. No good. No good, ladies and gentlemen. No good. Is that you? Sack Trades, is that you, bro? Is that you? Yes, I've got that slap chicken voice. Those of you who are going to do it in the Discord, do the memes, be my guest. All right, so, okay, give me your questions, ladies and gentlemen. Where are we at? Yeah, Tino, your voice, bro. Have you opened an OnlyFans? No, not yet. Yeah, it's quite an interesting turnout right now. I'm very interested in that. I want to see how the Nasdaq's behaving. Big pump, not bad. Is it done on light volume? More than likely. Let's have a look at the volume just for a second on the Nasdaq. Here we go. I need to put this in my mouth. My days. Okay. Volume's down. Yeah, volume is down quite a bit. That's no good. Okay. Initial treasury bill buying to be elevated for a few months. Oh, ends operational limit on standing overnight repo operations. Okay. The thing with Circle is you've got to understand that if we're going to have higher rates for longer, that's going to be a benefit to them. But even if the rates were to get cut, okay, Circle with its partnerships, it's going to actually continue. Why? Because they're creating a service where there is going to be a need to create revenue. They're going to create revenue, subject to, of course, the interest rate changes. I get all of that, but they're creating a service that generates revenue, and they're going to declare dividends on those revenues. Okay, so that's what's going to keep sending its price higher, because they're going to create a dividend. All right. The madness is reality. Bad man, what's good? We got the old boys coming in. What are your current thoughts on how bad ABTC is doing? Listen, let me just put it to you like this. With everything overvalued in the stock market, right? It's now a time to start buying. You're getting rate cuts. We're going to be told that for the next 2 years, rates are going to be in the range of 3.1 to 3.75. Okay. We're going to get projected 2 cuts, 2 quarter point cuts going into 2026. Some of them have said that we don't even want to cut. All right. So you've got to really understand that everyone's up in the air about how much money's going to cost. I think that once we do start changing the chair, that's going to change. This regime in the Fed is going to get flipped on its head. You heard it here. The second Trump changes the Fed chair, he's going to go in and wipe it all. And all that you're hearing now is going to be pointless, because they're just going to cut the rates, because Trump's relying on the revenue that is being built from tariffs. He wants to cut income tax because he knows that he can create the revenue from tariffs to sustain the US economy as such, and right, and afford the idea of cutting income tax. Okay, doesn't make sense from an economical point of view, but who said tax made sense? Here we go. Fed policymakers see end of 2026 PCE inflation at 2.4 versus 2.6. All right, so inflation is sticky. Fed projections show wide divergence of views for path of rates in 26 and beyond. They don't, that's what I'm saying. I just said that, and now we're reading that. The second Trump comes in, he's going to tell everyone, this is where we are, this is what we're going to do, this is how we're going to cut, and this is what you've got to expect. Right now, they're basing it on the economics. Trump's going to step in, put the new boy in, and he's going to be like, cut, 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 cut. Let's bring the rates down. Let's get money circulating. Forget about inflation. Don't worry about it. That's really what's going to happen. You're always going to have inflation. Your dollar's been violated so many times. Why do you care about inflation now? Your purchasing power, you're down nearly 50% of your purchasing power from how many years, right? Doesn't make sense, does it? So why would you care about it now? Anyways. Yeah, well, nah, don't worry. I'll just enjoy my little streak that I've got going off here, ladies and gentlemen. All right, here we go. Questions. How many of you are new? Type 1 if you are new. I want to know who my audience is. Tina, do you expect a small Santa rally? An elf rally? Yeah. I'll drink to the elves. Forgive me, ladies and gentlemen. This is not my normal voice. I'm so sorry. You know, I can't show you the Circle fund owners. The fund owners, it's 334. Sorry. Alex has welcome, my bro. My God, man. Coin Hoover, I know you're an OG, bro. I know you're the OG. You're back in the days. My days. Do you know no new people here? Just the Mexicans. Mexico. What's good? Tina, you sound like a proper gangster. Please. We don't sound like that. We? Anyways. Shit sometimes. Tina, do you expect a small Santa rally, then a drop in Q1, Q2? This is what I expect. Now that they've told us that they don't know where they are with the interest rates, okay, that stands for reason that Trump's going to push this idea of a new Fed chair, put him in and say, cut the rates, cut the rates. They're going to cut the rates so fast, the market's going to wet itself. That means anyone that's in risk right now will probably come out of it just to wait for the market to stabilize. Because when you think about it, when you cut the rates so aggressively, you're forcing in an injection of liquidity, and it needs to go to a place where they're not prepared for it in principle. Okay. So what you're really looking for is rotation, and the rotation has to happen smoothly. Okay. That's why they do it every other month. Okay. When they do the FOMC. All right. I'm all right, man. What can I say to you? Facts, according to the Bible, inflation will never come down and only keep going up. So if we're waiting for a new inflation, low inflation to pump risk assets, we wish that she goodbye. Okay. What episode of Narcos are we on? You brilliant people. Okay. Don't worry, man. I'm all good. Is it a good time to buy real estate in Cyprus? It depends what you're buying. All right. Because you've got to look at, it depends if you're going to be buying it in euros. Are you going to be spending dollars to buy the property in Cyprus for euros? Well, how are you going to be doing it? Okay. It's really important because the euro right now has got a problem with inflation. So they might not cut their rates anymore. All right. And even though the rate over there is at 2.14, they want to cut it down, bring it lower to induce more investment. But now that you've got the dollar getting close towards that 2.14%, where we are now at 3.75, it's an interesting one. But I would wait. Because house prices have gone up again. And that's a problem, especially when you've got this situation with interest rates. And that's in the US. Whatever happens in the US markets usually happens in the UK markets and the European markets. So it's always going to be mimicked. Welcome, New Geese here. How you doing? All right, and we've got 15 minutes until the actual FOMC projections come out. I'm done. I'm really done. Honestly. Would this be your highest point? Traders Cartel with you. Who's Traders Cartel? You sound like a granny on a Monday. It's a Wednesday, bro. A granny on a Wednesday. Will silver go up in the long term? Yes. Yes. Silver will go up. A projection that I've got for silver is $200 for silver and $6,500 for gold. That's what I'm looking at. Tina, from where are you reading these live streams? Can you share the source with us? It's just news anchors across the board. I've got APIs running, and I've got other things like Financial Juice. I've got all sorts of coming on my screens. I've got like 12 tabs of news anchors, and I'm just reading off each one that comes out. CME is a huge scam against retail. Never mind. Don't worry about that. Tino, the aggregated liquidity order book you show for Bitcoin, can I find this for gold futures too? Not necessarily, no. You can't. It's this right here. Okay, so look. This is something that you've got to pay attention to, right? So let me expand this out so you can see exactly what I'm talking about. This chart right here is very important. And Platinum members know that right now is a bit of a crazy time to be trading because you don't really have volume. Look, there's barely any volume, right? And what this tells me, when I read this, what it tells me is when it's red, it means that the offers are coming into play. That means they're selling the Bitcoin as it's going up, okay? Someone just sold a stack of Bitcoin, 27 million. So they just sold that on the peak of this move to the upside. Look at Bitcoin on the right over here, okay? See that? So they've just sold that Bitcoin. So there's someone that's just transacted for, okay, just $1 million right there. Okay, now this is the spot data. And the reason I look at the spot and not the futures is because the futures data is synthetic. This is really money that's coming in and out of positions. Now, when you see the red bars picking up, that's cool. But what you need to see is you want to see consistent behavior. We don't see that consistent behavior. There's not one dominated side yet. As you can see, you got bids here. Price came down. Now you got the offers, and the offers are coming in quick as well. This shows you the impulse of buyers and sellers, right? They're impulsive. Look at that big push right there. You don't want that big push. It needs to be progressive like this. You see this? We need to see a consistent flow because we don't see a consistent flow. It means that the investors or players in the game are sporadic with their investments. Quickly step in, get out, get in, get out. Okay, so you've got to take that into consideration when you are actually looking at trading Bitcoin. You can't get this data per se with Forex, but the only closest thing you can get to it is futures. You'll never get the true spot data from Forex or anything like that because Forex is spot. Euro, USD, dollar, yen, it's all spot data. We'll never know who's really buying or selling. Okay, then, cool. We're going to start getting involved in this story right now. We're going to get that coming into play. Nasdaq's still not really going anywhere. It's made a move up, but I'm not really interested in that. And VIX is going down. Red vectors back into green. Hedging could be coming into play. The 10-year futures and notes are moving up as well. S&P, nice little flavoursome move. It's trading S&Ps. it's a little bit easier on the soul. I'm like that with relationships, get in and then quickly get, okay, cool. Okay, let's have a look at Bitcoin futures, IBIT as well. Let's have a look at the actual ETF. Where are we at with the ETF? Okay, an hour ago, 1,500 ETH purchased. Outflows 8 hours ago. We had quite a bit of Bitcoin sold 8 hours ago. All right, so quite a lot sold. Inflows, not really that much. These are all little transactions here. Yeah, it's not really great. There's not that much Bitcoin being purchased, but more being sold. Solana coming up, back and choppy. Ethereum, well, fair play to Ethereum. It's moving up. I can understand why everyone's on the altcoin season flavor. I do sound rough, I know. The floor. Anyways. So, if you have 2 to 5K and you want to put them in for dividends, how does it work and why can't I understand this thing with the dividends? Well, you need to work out what asset class you're going to be investing in. Quite frankly, you want to be looking at ETFs that cover the bonds, treasury bonds. Look at REITs as well, REITs, okay, real investment trusts, all right? And buy gold ETFs, all right? Those are the 3 ETF classes that you really want to be focusing on when it comes to investing a surplus amount of liquidity into assets, which are not really prone to mad volatility. Like, for example, say you've got 5 to 10 grand, okay, and you want to create a dividend. Now, not all people have access to these, but you can get weekly paying dividends, right? But the conventional practice for everyone around the world is you want to get yourself into Vanguard ETFs, right? The VUs, which obviously tracks the major indexes and what have you. And then you want to look at the bonds, the treasuries, the TLTs, and what have those are the tickers. Add bonds to an ETF. So, for example, $1,000 on bonds, all right? Or depending on how risk averse you are, if you like risk, then put most of your capital into more volatile ETFs like tech-based ones. You could go for the Paris Saint-Germain ETF, which is just packed. iShares, BlackRock, it's just all packed with tech stocks. Microsoft, it's got all the Mag 7 in, right? And they created that quite a while ago. We spoke about that, all right? So that's one ETF that you could get involved in. And we just had news that we're going to get our FOMC, which is starting very shortly, ladies and gentlemen. Wait there. Wait there. I think we're going to get started. Hold on. Hold on. Not yet. Okay. Okay. I'm going to get into it now. We're just going to leave this here. There we go. Putting that there. Okay. Just going to keep an eye on that bad boy. And then I'll put the sound on it. Okay. So, yeah, that's where we are. So, yeah, what you can do is do that. Get yourself the bond ETFs, rates. I don't even know how they say it. Real estate investment trusts. That's what it's an acronym for. And buy gold ETFs. That way you're protecting yourself against inflation, inflationary pressures, economic downturns. When things are bad, everyone goes into gold. When things are good, in interest rates, because they're cutting them, then everyone's going to start going into purchasing houses, mortgages. That's going to generate a return. And then the bonds, when the market is favoring risk, they'll go into high risk and low risk at the same time and keep on plowing into the bonds market. So you're covering yourself. Then when you start adding other assets to it, like various other bonds, if you want to get international, then you start looking at Japanese ETFs that are supplied by JP Morgan. All right, I've been talking about that. Check those out. Just go and do some homework on Japanese ETFs that track companies in Japan. All right, JP Morgan supplies them, BlackRock supplies them as well. So just go and do that for me and you'll understand why. We're going into a big time with the Japanese, I'm telling you. And silver. Bro, my voice is fried, man. I don't care anymore. It's done. It's done. I'm just going to do this live stream and then I'll be all good, ladies and gentlemen. Here we go. Come on. I'm waiting for Jerome Powell to give us a flavor. Here we go. Okay. Oh. I just want to do sound check, ladies and gentlemen. I just want to do sound check. Okay, cool. No. I don't want to do that. Anyways. So yeah, look, listen, silver is a slow burner, but it does move. Okay, right now, I'll tell you what. Someone asked a really, really good question earlier on. Okay, I think it was Paul. Paul, big question. He said, "How can I use the copper gold ratio to trade the idea of copper?" All right. Well, you've got to understand with copper right now, there's a demand for it. With all this expansion that's happening around the world, okay, they're going to demand copper. Copper gold ratio, when the copper goes down, means there could be a turn in the economy, okay, because they're not putting copper to work. So when gold's going up, investors are scared. When copper's going up, right, it means there's economy, there's expansion. So if you start seeing the copper gold ratio climbing higher, it means that the economy is doing all right. When it's going down, it's a problem because it means that everything's slowing down. They're not putting copper to work. Okay? So that was a really good question. A really good question. It is a great question. Yeah, look, copper's price right now. After Trump said he would put a tax on it, look at that. Sent it up, dropped, and it's just claimed the whole range back. Excuse me. I'm 40 years old. I'm so sorry. Anyways, we're going to be getting the live stream very much. Okay, let's do a bit of a house. Let's do some housekeeping, ladies and gentlemen. All right. If you would care, if you care, you care. Please like the stream. And if you are new, read the screen behind me. It says like and subscribe if you like the bald head, whatever. Yeah, let's just do that. Oh, chill out. Yeah, listen, light trades, yeah, $200 silver, man. Not in Q1, Q2. Nah, not that quick. Not that quick. Can we expect a normal trading day tomorrow? Yeah, of course. Every day is a normal trading day. It's just today because we're not getting the full picture. We've been told. We've been told that we don't have a clear picture of interest rates. Back to business. I know. Ivaka, I know it does well. All right, let's get with this program. Let's break it all down and prepare ourselves for the FOMC. Ladies and gents, it's been a pleasure. I get to rest my voice for a little bit. Yeah, come on then. Cannabis stocks, man. They're good. I'm going to save my voice. I am going to save my voice. I'm going to prepare Bitcoin. Let's see if Bitcoin is going to give us that nice move. Where's Bitcoin's price? Put it up there. Okay. The guy I'm kind of... Oh, what the hell? Level third basement. What the hell do you need to care about a basement for, bro? Tino, what about the up-and-coming December 19th meeting with Japan? Rate hike. Yeah. Everything's going to come down on the rate hike. That's it. They'll pull it back. Simple. Come on. Come on. So we got 4 more minutes, ladies and gentlemen. Okay, again, so anyone that is new, remember, head to tradersreality.com if you are completely new. And you watch all the videos here on how to get the hybrid system. Join the Discord here. If anyone wants to know about how to get into the Discord, it's free. Just jump into it here. Just go to the homepage on the website and check that out. And of course, the update right now that's happened on BTCC, where you can trade your off trading view, connecting BTCC to it. If you want to check that out, in the description, I've included a watch list, which gives you the update for the tech stocks. I haven't added anything else, but there's a watch list that gives you NASDAQ, yen, the Japanese Nikkei index and the Dow Jones and the S&P 500 to trade on TradingView via BTC. So you got to do is just connect your account into it. You just type in, where we go, here you go, BTCC, and it's right there, just been put up. And then you can trade off TradingView rather than trading on the platform itself. Okay, cool. Everything you need is in the description of the live, and that's happy days. Cool. All right, and that watch list is also in the description, so you can download that. It's just use the link. It will take you. It'll bring it up to you for you. Sorry. Okay. Right, here we go. I'm going to put my headphones on. When is the best time to buy silver? It's just silver and gold, like Bitcoin. It's just one of those you just got to keep accumulating. But silver and gold have stood the test of time. Bitcoin hasn't. Remember that. How long have they been trading gold? How long have they been trading Bitcoin? Yeah? That's all you've got to understand. You're safer with gold and silver. If you want to add Bitcoin to your pot, okay, cool. There's no problem with that. But your legacy plays are silver and gold. Simple. Never mind. You're buying the way down. That's true. Fine, we connect BTCC to TradingView. Fast in, fast out. That is it. Yep. So I think if you join with the Traders Reality link, you do get, you don't need KYC or VPN. And you get a 10% deposit bonus, which is paid out on a Wednesday, every Wednesday. Up to 100K. That's your deposit limit. No, bonus. So it means you get 10K, basically. Okay, then. Yeah, that's a bit wild. I saw that comment 7 minutes ago. Federal Reserve lowers. Yeah, I saw that. Altcoins are for suckers. Wow. I mean, yeah, just make some money off them. But all right, and here we go, ladies and gentlemen. I think we're going to get into it. I'm going to rest my voice a little bit. We're going to hear what he has to say. And let's hope for the best. Come on. Watch ETH, not Bitcoin. It's Bitcoin. Everyone wants to know what Bitcoin's doing. Yes, I've read Ray Dalio's Changing the World Order. Here we go, ladies and gentlemen. Good afternoon. No. What's it doing? No. I don't know why it did that. Anyways, we're in. We're in, ladies and gents. We're in. We are in. All right. I'm hoping that we can hear something. Here he is.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although important federal government data for the past couple of months have yet to be released, available public and private sector data suggests that the outlook for employment and inflation has not changed as much since our meeting in October. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals, in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by 1/4 percentage point. As a separate matter, we also decided to initiate purchases of shorter-term Treasury securities solely for the purpose of maintaining an ample supply of reserves over time, thus supporting effective control of our policy rate. I will have more to say about monetary policy and its implementation after briefly reviewing economic developments. Although some key government data have yet to be released, available indicators suggest that economic activity has been expanding at a moderate pace. Consumer spending appears to have remained solid, and business fixed investment has continued to expand. In contrast, activity in the housing sector remains weak. The temporary shutdown of the federal government has likely weighed on economic activity in the current quarter, but these effects should be mostly offset by higher growth next quarter, reflecting the reopening. In our summary of economic projections, the median participant projects that real GDP will rise 1.7% this year and 2.3% next year, somewhat stronger than projected in September.
Wow.
In the labor market, although official employment data for October and November are delayed, available evidence suggests that both layoffs and hiring remain low. and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continued to decline. The official report on the labor market for September, the most recent release, showed that the unemployment rate continued to edge up, reaching 4.4%, and that job gains had slowed significantly since earlier in the year.
4.4.
A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. In our SEP, the median projection of the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but
Here it
remains
is.
somewhat elevated relative to our 2% longer-run goal.
There's that 2% target.
Very little data on inflation have been released since our meeting in October. Total PCE prices rose 2.8% over the 12 months ending in September, and excluding the volatile food and energy categories, core PCE prices also rose 2.8%. These readings are higher than earlier in the year as inflation for goods has picked up, reflecting the effects of tariffs. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have declined from their peaks earlier in the year, as reflected in both market and survey-based measures. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.9% this year and 2.4% next year, a bit lower than the median projection in September. Thereafter, the median falls to 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.5 to 3.75%. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. A reasonable base case is that the effects of tariffs on inflation will be relatively short-lived, effectively a one-time shift in the price level. Our obligation is to make sure that a one-time increase in the price level does not become an ongoing inflation problem. But with downside risks to employment having risen in recent months, the balance of risks has shifted. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. Accordingly, we judged it appropriate at this meeting to lower our policy rate by a quarter percentage point. With today's decision, we have lowered our policy rate 3/4 of a percentage point over our last 3 meetings. This further normalization of our policy stance should help stabilize the labor market while allowing inflation to resume its downward trend toward 2% once the effects of tariffs have passed through.
Blaming tariffs,
The
okay.
adjustments to our policy stance since September bring it within a range of plausible estimates of neutral and leave us well-positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our summary of economic projections, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of 2026 and 3.1% at the end of 2027, unchanged from September. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Monetary policy is not on a preset course, and we will make our decisions on a meeting-by-meeting basis. Let me turn now to issues related to the implementation of monetary policy, with the reminder that these issues are separate from and have no implications for the stance of monetary policy.
That's no good with gold. That's no
In
good.
light of the continued tightening in money market interest rates relative to our administered rates and other indicators of reserve market conditions, the committee judged that reserve balances have declined to ample levels. Accordingly, at today's meeting, the committee decided to initiate purchases of shorter-term Treasury securities, mainly Treasury bills, for the sole purpose of maintaining an ample supply of reserves over time. Such increases in our securities holdings ensure that the federal funds rate remains within its target range and are necessary because the growth of the economy leads to rising demand over time for our liabilities, including currency and reserves. As detailed in a statement released today by the Federal Reserve Bank of New York, reserve management purchases will amount to $40 billion in the first month and may remain elevated for a few months to alleviate expected near-term pressures in money markets. Thereafter, we expect the size of reserve management purchases to decline, though the actual pace will depend on market conditions. In our implementation framework, an ample supply of reserves means that the federal funds rate and other short-term interest rates are primarily controlled by the setting of our administered rates, rather than day-to-day discretionary interventions in money markets. In this regime, standing repurchase agreement, or repo operations, are a critical tool to ensure that the federal funds rate remains within its target range, even on days of elevated pressures in money markets. Consistent with this view, the committee eliminated the aggregate limit on standing repo operations. These operations are intended to support monetary policy implementation and smooth market functioning and should be used when economically sensible.
They're advertising the reverse repo because no one's investing in it.
The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing our inflation sustainably down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. At the Fed, we will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Do you look forward to the questions? Here we go, ladies and gents.
Thank you. Howard Schneider with Reuters. Just first turning to the statement, just to be clear, we're on the same page here. The insertion of the phrase, considering the extent and timing of additional adjustments, does that indicate that the Fed is now on hold until there's some clearer signal from inflation or jobs or the evolution of the economy along the baseline outlook?
Nice question.
So, yes, the adjustments since September bring our policy within a broad range of estimates of neutral. And as we noted in our statement today, we are well positioned to determine the extent and timing of additional adjustments based on the incoming data, the evolving outlook, and the balance of risks. That new language points out that we'll carefully evaluate that incoming data. And also, I would note that having reduced our policy rate by 75 basis points since September and 175 basis points since last September, the Fed funds rate is now within a broad range of estimates of its neutral value, and we are well positioned to wait to see how the economy evolves.
What the hell did he just
If I could
read?
follow up on the outlook there. It seems like with the additional GDP growth coupled with easing inflation and a fairly steady unemployment rate, this seems like a pretty optimistic outlook for next year. What's given rise to that? Is this an early bet on AI? Is there some sense of improving productivity out there? What's driving that?
So a number of things are driving
He is reading the
what's
answer.
happening
Now
in the
he's not
forecast.
reading
And
the
I would say
answer.
if you look broadly at outside forecasts, you do see a pickup in growth in many of those now too. So it is it's partly that consumer spending has held up, it's been resilient, and it to another degree it is that AI spending on data centers and related to AI has been holding up business investment. So overall, the baseline expectation for next year is, at least at the Fed, and I think with outside forecasters too, is a pickup in growth from today's relatively low level of 1.7%. I mentioned that the SEP median is 1.7 for this year growth and 2.3 for next year.
Say it.
You actually, some of that is due to the shutdown. So you can take 0.2 out of 2026 and put it in 2025. So it would really be 1.9 and 2.1. But overall, yes, for a few reasons, fiscal policy is going to be supportive. And as I mentioned, AI spending will continue. The consumer continues to spend. So it looks like the baseline would be solid growth next year.
Oh, you freaking roundabout guy.
Thank you, Mr. Chairman, for taking
Come
my
on,
questions
Steve,
here.
say it.
You had previously described rate cuts in terms
Steve
of a
lies,
risk
man.
management framework, and
Isn't
kind
he?
of following up on what Howard was asking. Is the risk management phase of rate cuts over here, and have you taken out sufficient insurance, I guess, against potential weakness in terms of the data we might get next week when it comes to employment?
So we're going to get a great deal of data between now and the January meeting, and I'm sure we'll talk more about that. And the data that we get are going to factor into our thinking. But yes, we have, if you go back, we held our policy rate at 5.4% for more than a year because inflation was high, very high, and unemployment in the labor market was really solid at that point. So what happened is over last summer of 24, inflation came down.
He's going to
and
story
the
mode,
labor
guys.
market began to show real signs of weakness, and so we decided, as our framework tells us to do, that when the risks to the two goals become more equal, you should move from a stance that favors really dealing with one of them, in that case inflation, to a more balanced, more neutral setting. And so we did that. We did some cutting, and then we paused for a while to work our way through what was happening in the middle of the year. And then we resumed cuts in September, and we've cut now 3. We've now cut a total of 175 basis points. And as I mentioned, we feel like where we're positioned now we're well
Story
positioned
time.
to wait and see how the economy evolves from here.
Yeah, thank you.
If I could just follow up on the SEP, you have a whole lot of big increase in the growth numbers, but not a big decline in the unemployment numbers. And is that an AI factor in there? What is going on in terms of the dynamic of you get more growth, but you don't get a whole lot of decline in unemployment? Thank you, sir.
So the implication is obviously higher productivity. And some of that may be AI. It just also, I think, productivity has just been almost structurally higher for several years now.
Gold
So if you start
dropping
thinking
is
of it
not
as
good.
2% per year, you can sustain higher growth without more job creation. Of course, higher productivity is also what enables incomes to rise over long periods of
There's
time.
your
so
evidence.
It's basically a good thing, but that's certainly the implication.
Sorry, guys.
Thank you. Colby Smith with the New York Times. Today's decision was clearly very divided. It wasn't just the 2 official dissents against a cut, but there were also soft dissents from 4 others. And I'm just wondering if this reluctance from several people to support recent reductions suggests that there is a much higher bar for cuts in the near term. And what exactly does the committee need to see if things are well positioned right now to support a January reduction?
Sure. So let me just say, as I mentioned, and as I've mentioned here before, the situation is that our 2 goals are a bit in tension, right? So interestingly, everyone around the table at the FOMC agrees that inflation is too high and that we want it to come down, and agrees that the labor market has softened and that there's further risk. Everyone agrees on that. Where the difference is how do you weight those risks, and what does your forecast look like, and where do you, ultimately where do you think the bigger risk is, and it's very unusual to have persistent tension between the 2 parts of the mandate, and when you do, this is what you see, and I think it's actually what you would expect to see, and we do see it. Meanwhile, the discussions we have are as good as any we've had in my 14 years at the Fed. They're very thoughtful, respectful, and you just have people who have strong views, and we come together and we reach a place where we can make a decision. We made a decision today. We had 9 out of 12 supported it, so fairly broad support. But it's not like the normal situation where everyone agrees on the direction and what to do. It's more spread out, and I think that's only inherent in the situation. In terms of what it would take, we all have an outlook in terms of what's going to come, but I think ultimately having cut 75 and the effects of the 75 basis points will only begin to be coming in. As I've said before a couple times, we're well positioned to wait to see how the economy evolves. We'll just have to see. And we will get, as you know, quite a bit of data. I should mention on the data, as long as I'm talking about it, that we're going to need to be careful in assessing, particularly the household survey data. There are very technical reasons about the way data are collected in some of these measures, both in inflation and in labor, in the labor market, so that the data may be distorted and not just sort of more volatile, but distorted, and that's really because data was not collected in October and half of November. So we're going to get data, but we're going to have to look at it carefully and with a somewhat skeptical eye by the time of the January meeting. Notwithstanding that, we will have a lot of the December data by the time of the January meeting. So we expect to see a lot more, but I'm just saying that what we get for example, CPI or for the household survey, we're going to look at that really carefully and understand that it may be distorted by very technical factors.
And just
Thanks, pal.
one more question on dissent.
Nice.
I mean, you talk about it in a very positive way, just given the complicated nature of the situation we're in economically. But is there any point in which those dissents become counterproductive, either to the Fed's communication and the messaging around the policy path forward?
I don't feel that we're at that point at all. I don't. I would say, again, these are good, thoughtful, respectful discussions, and you hear people say, and you hear many outside analysts say the same thing. I could make a case for either side. I mean, I could make that case. It's a close call. We have to make decisions, and we always hope that the data will give us a clear read. But in this situation, you have competing. If you look through the SEP, you'll see that
He's waffling.
a very large number of participants agree that risks are to the upside for unemployment and to the upside for inflation. So what do? You've got one tool. You can't do two things at once. So at what pace do you move? What size moves do you make, and that kind of thing? And what's the timing of them? It's a very challenging situation. I think we're in a good place to, as I mentioned, to wait and see how the economy evolves.
Nick. Nick Timmerosa, The Wall Street Journal.
Here we go.
Chair Powell, there's been some discussion recently of the 1990s. In the 1990s, the committee did two discrete sequences of 3 quarter-point cuts, one in 1995-96 and one in 1998. And after both of those, the next move in rates was up, not down. With policy now closer to neutral, is it a foregone conclusion that the next move in rates is down, or should we think of policy risks as genuinely two-sided from here?
Wow.
So I don't think that
You're basically saying that you're going to cut the rates to only increase them again.
A rate hike is anybody's base case at this point, and I'm not hearing that. What you see is some people feel we should stop here and that we're at the right place and just wait. Some people feel like we should cut once or more this year and next year. But when people are writing down their estimates of policy of where it should go, it is either holding here or cutting a little or cutting more than a little. So I don't see the base case as involving that. So of course, a data set of 2, now 3, is not a big data set. But you are right about those 2 3-cut times in the 90s.
If I could follow up, the unemployment rate has been rising very gradually for the better part of 2 years, and indeed the statement today no longer describes the unemployment rate as remaining low. What gives you confidence it won't continue rising in 2026, especially when housing and other rate-sensitive sectors still appear to be feeling restrictive policy from the, notwithstanding the 150 basis points in cuts prior to today?
So I think the idea is that with now having cut 75 basis points more now and having policy, I'd call it in a broad range of plausible estimates of neutral, that will be a place which will enable the labor market to stabilize or to only tick up 1 or 2 more tenths, but we won't see, any kind of a sharper downturn, which we haven't seen any evidence of at all. At the same time, policy is still in a place where it's not accommodative, and we feel like we have made progress this year in non-tariff related inflation, and as tariffs come through, as they flow through, that'll show through next year. But as I said, we're well placed to wait and see how that turns out. That is our expectation, but we're going to start to see the data, and it'll tell us whether we were right or not.
Claire.
Okay.
Claire Jones, Financial Times. A lot of people interpreted your comments at the October meeting that, when there's a foggy situation, we slow down, to mean that, there wouldn't be a cut now, there'd be a cut in January instead. So it'd be good to get a sense of why did the committee decide to move today rather than to move in January instead? Thank you.
Right. So in October, I said that there was no certainty of moving, and that was indeed correct. I said it's possible you could think about it that way, but I was careful to say other people could look at it differently. So why did we move today? I would point to a couple things. First of all, gradual cooling in the labor market has continued. Unemployment is now up 0.3 from June through September. Payroll jobs averaging 40,000 per month since April. We think there's an overstatement in these numbers by about 60,000, so that would be negative 20,000 per month. And also, just to point out one other thing, surveys of households and businesses both show declining supply and demand for workers. So I think you can say that the labor market has continued to cool gradually, maybe just a touch more gradually than we thought. In terms of inflation, it's come in a touch lower, and I think the evidence is kind of growing that what's happening here is services inflation coming down, and that's offset by increases in goods, and that goods inflation is entirely in sectors where there are tariffs. So that does build on the story, and so far it's only a story, that that the goods inflation, which is really the source of the excess at this point, almost more than half the source of the excess inflation is goods, is tariffs. And you've got to say then, so what do we expect from tariffs? And I would say that is to some extent down to looking for broader economic heat. Do we see a hot economy? Do we see constraints? Do we see what's going on with wages? You saw the ECI report today. It doesn't feel like a hot economy that wants to generate, Phillips curve kind of inflation. So we look at all those things, and we say that this was a decision to make. It obviously wasn't unanimous, but overall that was the judgment that we made, and that's the action we took.
And just on the ample reserves point, how concerned were people around the table about some of the tensions we've seen in money markets? Thank you.
I wouldn't say concerned. So what really happened is this. Balance sheet shrinkage, sometimes called QT, went on. We had a framework in place for monitoring it, and nothing happened. The overnight reverse repo facility went down pretty much close to zero. And then beginning in September, the federal funds rate started to tick up within the range, right? And it ticked up almost all the way to interest-on reserve balances. There's nothing wrong with that. What that's telling you is that we're actually in an ample reserves regime. So, we knew this was going to come. When it finally did come, it came a little quicker than expected, but we were absolutely there to take the actions that we said we would take. So, and those actions are today. So, we announced that we're resuming reserve management purchases. That is completely separate from monetary policy. It's just we need to keep an ample supply of reserves out there. Why so big? The answer to that is, if you look ahead, you'll see that April 15th is coming up, and our framework is such that we want to have ample reserves even at times when reserves are at a low level temporarily. So that's what happens on tax day. People pay a lot of money to the government, reserves drop sharply and temporarily. So this seasonal buildup that we'll see in the next few months was going to happen anyway. It was going to happen because April 15th is April 15th. There's also a secular ongoing growth of the balance sheet. We have to keep reserves, call it constant, as it relates to the banking system or to the whole economy. And that alone calls for us to increase about $20–25 billion per month. So that's a small part. That's going on. It's also happening in the context of a temporary few-month front loading to get reserves high enough to get through the tax period in mid-April. So that's what's happening there.
Oh man, it's terrible. This is terrible. Such long
Thanks, Mr.
questions
Chairman.
and answers.
This is the last post-FOMC press conference before an important Supreme Court hearing next month. Can you talk about how you're hoping the Supreme Court will rule? And I'm just curious why the Fed's been so reticent on such a pivotal matter.
It's not something I want to address here, Andrew.
Of course you don't.
You know, we're not legal commentators.
It's
before the courts, and we think we don't think that we help matters by trying to engage as a public discussion of that.
Good on you, pal. Well done, bro.
I don't know if that means I
What a
get two
guy.
questions,
No,
but
just one more.
I guess I wanted to come back to the 1990s question, and like, do you see that as a useful model for thinking about what is happening in the economy right now?
I don't think it rises to that level.
What's
So
good,
I did
RTB?
think that in 2019, where we cut 3 times, but you know, this is such a unique situation. It's not the 1970s, let's put it that way, but we do have tension between our two goals. And so that's just unique in my time at the Fed, and I think going back a long ways, we haven't had that. In our framework, as you know, says that when that's the case, that we try to, take a balanced approach to the two things, and we look at how far they are and how long it would take to get them back to each of them back to the goal. And that's
Bad
a
luck,
very
guys.
subjective analysis, really. But it just tells you've got to, and I think ultimately what it says is when they're broadly equally threatened or equally at risk, you should be kind of neutral. Because if you're either accommodative or tight, you're favoring one or the other goal. And so we've been sort of moving in the direction of neutral. Now we're in the range of neutral. We're in the high end of the range of neutral, I would say. And that's what we're doing now. It so happened that we've cut 3 times. That we haven't made any decision about January, but as I've said, we think we're well positioned to wait and see how the economy performs.
Edward.
Unbelievable.
Thanks, Mr. Chairman. Edward Lawrence with Fox Business. I wanted to ask you, the inflation expectations has come down in your SEP report. Do you see the tariff?
Right, watch out
price
for vector
increases
recoveries here,
as
guys.
passing
Be
through in the next
careful.
3 months? Is it a 6-month process that we're looking
Very
for that?
careful
And
here.
then because of that, is jobs the threat to the economy?
So with tariff inflation, there's the announcement of a tariff, and then there's, they start to take effect, and then it takes some months. Goods may have to be shipped from other parts of the, it may take, quite a while for an individual tariff to take its full effect. But once it's had that effect, then the question is, isn't that just a one-time price increase? So we actually look at it, all of the announcements and what you get from all that. You see sort of for each one of them, there's a time period, and then it's fully in. So if there are no new tariff announcements, and we don't know that, but let's assume there are no major new tariff announcements, inflation from goods should peak in the first quarter or so, right, or roughly. We haven't been able to predict this with any precision. No one is. But call it the first quarter or so of next year should be the peak. And from here, it shouldn't be big. It should be a couple tenths or even less than that. We don't really have precision on this. And after that, again, if there are no new tariffs that are being announced that will take 9 months to get fully in, and 9 months is also an estimate, then you should start to see that coming down in the back half of next year.
And I wanted to see if I could address sort of the elephant in the room. The president's been talking openly about a new Fed chairman. Does that hinder your current job right now or change your thinking at all?
Nice. No. No. See you later. Question done. Ciao, ciao.
Michael McKee
Taxi.
from Bloomberg Radio and Television. 10-year rates are 50 basis points higher than when you started cutting back in September of 2024, and the yield curve basically has been steepening. Why do you think that continuing to cut now, especially in the absence of data, is going to bring down the yield on the thing that will move the economy the most?
So we're looking at the real economy and focusing on that. And you've got when the long bonds move around, you've got to look at why they're moving around. If you look at inflation compensation, it's very that's one part of it is inflation compensation break-evens, and they're at very comfortable levels. They're at levels consistent once you get out past the very short term now. Break-evens are at at quite levels that are quite consistent with 2% inflation over time. So there's nothing happening with rates going up out there that suggests concern about inflation in the long term or anything like that. I mean, I look at these things pretty regularly. Same thing with surveys. Surveys are all saying that the public understands our commitment to 2% and expects us to get back there. So why are rates going up? It has to be something else. It must be, an expectation of higher growth or something like that. And that's a lot of what's been going on. I mean, you saw a big move, toward the end of last year, which was not to do with us. It was to do with other developments.
Trump's posted
you
something.
Just mentioned that the public is expecting you to get
Trump
back
Gold
to 2%.
Card is here.
And Americans overwhelmingly are citing high prices, inflation as their number one concern. Can you explain to them why you're prioritizing the labor market, which seems relatively stable to most people, instead of their number one concern, inflation?
So we, as you know, we have
Interesting.
A network of contacts in the U.S. economy, which is really unmatched if you go through the 12 reserve banks. So we hear loud and clear how people are experiencing really costs. It's really high costs. And a lot of that is not the current rate of inflation. A lot of that is just embedded higher cost due to higher inflation in 2022 and 23. So that's what's going on. And so the best thing we can do is restore inflation to its 2% goal, and our policy is intended to do that, but also have a strong economy where real wages are going up, where people are getting jobs and earning money, and we're going to need to have some years where real compensation is higher, it's positive, significantly positive, so nominal wages are higher than inflation, for people to start feeling good about the affordability issue. And, so we're working hard on that. We're trying to keep inflation under control, but also support the labor market and strong wages so that people are earning enough money and feeling economically healthy again.
Victoria.
Man, he's got the same cold.
Just to follow up on that, I mean, this is now the third time that you've cut this year, and inflation is around 3%. So is the message that you're sort of trying to send with that you're okay with where inflation is for now, as long as people understand that at some point you still want to get back to 2% because inflation is relatively stable where it is?
Everyone should understand, and the surveys show that they do, that we're committed to 2% inflation, and we will deliver 2% inflation. But it's a complicated, unusual, difficult situation where the labor market is also under pressure, where job creation may actually be negative. Now, supply of workers has also gone way down, so the unemployment rate hasn't moved that much. But, it's a labor market that seems to have significant downside risks. People care a lot about that. That's their jobs. That's their ability, if they get laid off or if they're entering the labor force, to find work. So that's really important to people.
Not quite.
With inflation, and we're well aware that this is a story at this point, is that if you get away from tariffs, inflation is in the low 2s, right? So it's really tariffs that's causing most of the inflation overshoot. And we do think of those as likely to, in the current situation, as likely to be a one-time price increase. Our job is to make sure that it is, and we will do that job. But right now, you've got this difficult balance, and there are risks to both sides. There's no risk-free path. If it was just inflation and the labor market was just really strong, and then rates would be higher, as they were for more than a year. We didn't have to worry about inflation. Sorry, about the labor market, because the labor market unemployment was very low. If you remember when inflation was very high, there was a labor shortage, so we could focus entirely on inflation. Now it's different. We actually have risks to both, and I think we're doing the best we can for people. They also care about their jobs. They do care about affordability, and the best thing we can do there is both to support economic activity, but also, make sure that when tariff inflation goes down and disappears, inflation lands around 2%.
Elizabeth. Thanks so much, Elizabeth Schulze with ABC News. Just to follow up, you keep talking about job growth being negative. Why do you think job growth is so much worse than some of the official data? Why do you think job growth is, to follow up on your comments about job growth, why is it so much worse than the official data is suggesting?
Oh, well, we know, I think this is, I don't think this is particularly controversial. It's very difficult to estimate job growth in real time. They don't count everybody, they have a survey. And there's been something of a systematic overcount. And so we expected, and they correct it twice a year. So the last time they corrected it, we thought the correction would be 800,000 or 900,000. I won't get the numbers exactly right. And that was exactly what happened. So we think that has persisted. And so there's an overcount in the payroll job numbers, we think, continuing, and it will be corrected. I don't have the exact month in my head right now, and that's just, I think forecasters generally understand that. So, and we think it's about 60,000 a month, so 40,000 jobs could be negative 20, and that could be wrong by 10 or 20 in either direction. But in any case, but the thing is, that's
oh man, he's running his mouth today.
In a way, that's demand. Labor supply has also come down quite sharply. So,
Trump's hosting a roundtable.
Had a world where there's just no growth in workers, and you really don't need a lot of jobs to have full employment. Some people argue that's what we're looking at. But I think a world where job creation is negative, I just think we need to watch that situation very carefully and be in a position where we're not, pushing down on job creation with our policy.
Trump's going to pump the market.
Supply, we have seen major American employers like Amazon cite AI in job cuts. How much right now are you factoring in AI into the current weakness in the job market?
So it's probably part of the story. It's not a big part of the story yet. We don't know whether it will be. But, for example, if you look at, you can't miss the big announcements of layoffs and also companies saying that they're not going to hire anybody for a long time, and they cite AI. That's all clearly happening. At the same time, people are not filing for unemployment insurance, and since job creation, job finding rates are extremely low, if there were big numbers of layoffs, you'd expect the continuing claims to go up, and you expect new claims to go up. It really haven't much, so it's a little bit curious. But longer term, though, the question is, what are we going to see here? And we don't know, but it's it may be that in past technology, really significant technology innovation eras, you have seen some jobs destroyed and other jobs made. Ultimately, what's happened for a couple hundred years is when you get through all that, you have higher productivity and you have new jobs, and there are enough jobs for people. This may be different. It's every time we have a wave of technology, we think, oh, this could put a lot of people out of work. What are they going to do? In the past, there's always been more work and higher productivity, and incomes have risen. What will happen here, we're going to have to see. But right now is such early days. We don't think we see much. It's certainly not showing up in layoffs yet.
I love this
Chair.
guy.
And the current Bloomberg News, given the breadth of views on the policy committee, why is there such a division of views between
On the policy what?
On the committee.
Thank you.
Why is there such a division of views between the presidents and the board members?
It's not so stark as that. The views are more varied in each group as well. There's some of that, but I would say they're also
Michael Dell, yeah,
and they're people on both sides in both groups. I wouldn't put too much in that.
Okay, and just to follow up, please, given your growth upgrade, how would you factor in, or what would be the economic impact if the Supreme Court is to strike down the tariffs that they're currently hearing, please, in terms of growth and inflation? Thank you.
I really don't know. It would depend. It would depend on a whole bunch of things we don't know. So I can't really help you there.
How's the best? Powell is the best. Can't help you.
Thank
Nope.
you, Chair Powell. Christine Romans, NBC News. I wanted to ask you about how the higher income households are really driving spending right now. They're backed by home equity and stock market wealth, but lower income consumers are really struggling with the accumulation of 5 years now of rising prices. It's price levels, not really the inflation rate, holding some of these families back. How sustainable is this so-called K-shaped economy, and what are the Fed's thoughts on whether that's a risk going forward?
So we do, through our vast network of contacts and just through our observation of what's going on in the economy, we hear about this a lot.
Do you want to listen to Trump or Powell?
To the earnings
Tell me.
reports for consumer-facing companies that tend to
Type
deal
1
with
if you want to
low and
listen to
moderate-income
Trump.
people, they'll all say
Type 2 if you want to listen
that
to
we're
Powell.
seeing people, tightening their belts, changing products that they buy, buying less, and that sort of thing. And so it's clearly a thing. It's also clearly a thing that, asset values, housing values, and securities values are high, and they tend to be owned by people more at the higher end of the income and wealth. So as how sustainable it is, I don't know. Most of the consumption does happen by people who have more means. I think, the top,
Is it
the
real?
top third accounts for way more than a third of the consumption, for example. So it's a good question how sustainable that is. The best we can do is to have a, price stability and a strong labor market. And what we saw, for example, what we saw at the end of the, the very, very long expansion that ended with the outbreak of the pandemic, we saw that it was
He's
10
kissing
years
Dell's
and
Technologies
8 months or
backside.
something like
Don't
that.
need to worry about that.
The longest one in recorded history.
He's just
In
kissing
the last
Dell's
2
ass.
years, most of the job, the
Look at the
largest part
subtitles.
of the wage gains.
He's just saying we've got people joining.
In the bottom
No need.
quartile, the bottom part of the low and moderate income.
Thanks to Hewlett-Packard.
Having a strong labor market for a long period of time is really, really good from a social standpoint. It's helping people at the lower income levels, and that's what we all want to get back to. But we got to have price stability, and we got to have full employment, maximum employment.
And just quickly, you mentioned the housing market remains kind of weak. With these rate cuts that we've seen, is there a chance we're going to see more affordability in the housing market so more people can maybe enjoy that part of wealth creation? I mean, the average age or median age of a first-time home buyer is now 40 years old. That's the highest on record.
Yeah, so the housing market faces some really significant challenges. And I don't know that, a 25 basis point decline in the federal funds rate is going to make much of a difference for people. Housing supply is low. Many people
I'm switching to Trump. Hold on.
Success.
Nice. Let's talk about Cristiano Ronaldo.
About your company, you've done amazing. An executive director of the Technology CEO Council, Bruce.
Very quiet, guys.
So, thank you very much. I think that these people know each other. We're gonna be
of different kinds. So
wait till he starts talking about something.
A problem.
Not really
and,
saying
really
anything.
The tools to address it are we can raise and lower interest rates, but we don't really have the tools to address, a secular housing shortage, a structural housing shortage.
Chris.
Thanks. Chris Rugaber, Associated Press. You mentioned on inflation, services inflation being low, goods inflation looking like maybe it'll peak. We had the wages report you mentioned today showing moderating wage growth. Where are there inflation risks? It looks like inflation is cooling, in your view. At the same time, you have potentially negative hiring. Why not? Why aren't we hearing more about maybe more cuts in this environment?
Well, I think the risk in inflation is pretty clear to see, and that is, we see higher inflation. As I mentioned, most of the inflation over target is from goods, and we estimate, we expect, most of us, that inflation will be a one-time price increase and then come down. We just came off an experience where inflation turned out to be much more persistent than anyone had expected. Is that going to happen now?
Pump till Japanese.
So that's the risk. The risk is either that tariff inflation just turns out to be more and more persistent, maybe because companies who are now holding back from passing through the tariffs we'll just keep doing that. So you'll see, you see that. I think the other possibility is less likely, and that is just that the labor market gets tight or the economy gets tight, and you see just traditional inflation. I don't see that as particularly likely. But so I think again all across the committee, people see the picture pretty similarly, but see the risks quite differently.
We've got big pump on Bitcoin so far. I need to see the volume.
Risk, and I wouldn't dismiss that case. I don't dismiss that case, but you've got to
big spot volume, man. Big spot is being sold. They're selling a lot of Bitcoin now. 80 million. Look at that.
Chair Powell, Neil
One,
with Axios.
2,
so
3,
this has come up a couple of times today, but
big volumes being sold.
Do you believe that we're experiencing a positive productivity shock, whether from AI or policy factors or whatever? And how much is that driving the higher GDP projection in the SEP?
So yeah, I mean, I never thought I would see a time when we had 5-6 years of 2% productivity growth. This is higher. This is definitely higher, and it was before.
Sweep of that range. Go on, NASDAQ. Asia tonight's going to be fun.
I also think if you look at what AI can do, and if you use it in your personal life, as I imagine many of us have, you can see the prospects for productivity. I think it makes people
a lot of Bitcoin being sold.
It may make other people have to find other jobs, though. So it could have productivity implications while also having social and labor market implications that we don't have the tools to deal with. But yes, I think we're definitely seeing higher productivity. I think it's a little quick to be saying it's generative AI.
Gold is reacting to the rate cut. That's it.
The pandemic may have induced people to do more automation and do more things with computers to replace people, and that raises productivity, output per hour.
Does that imply does that imply higher neutral rate, and therefore the policy might be a little easier than it seems?
All things equal, yes, but all things aren't equal. There are many things pushing in different directions on where the neutral rate would be. But yes, that argument does come up.
Matt Egan.
Matt, your questions are boring tonight. They are boring questions for Powell.
Matt Egan with CNN. After today, you only have 3 more meetings at the helm of the Fed. Since becoming Fed chair, you've seen trade wars, the pandemic, COVID reopening, period of high inflation. I know your term's not up as chair until May, but I'm wondering if you've given any thought to what you want your legacy to be.
My legacy. My thought is that
here we go.
I really want to turn this job over to whoever replaces me with the economy in really good shape. That's what I want to do. I want inflation to be under control, coming back down to 2%, and I want the labor market to be strong. That's what I want. And all of my efforts are to get to that place. They have been all along, but ultimately, that's what I'm. And it's I don't have time to think about
255 Bitcoin has been transferred from an unknown wallet to Coinbase.
Worried about that.
Why would they do that if it's rising?
Relatedly, have you given any more thought, and can you tell us any more about your plans on whether or not you plan to stay on the Fed Board of Governors even after your term as chair expires?
This chart tells you the short. Look at it.
I'm focused on my remaining.
Look at how the volume is massive. They sold a lot of Bitcoin.
To tell you.
Now it snapped it back. These are little quick scalps you can use.
Chairman Mark Hamrick with Bankrate. Even while many price levels remain elevated, the reductions in the federal funds rate means that savings rates, or yields to be more precise, have peaked, while key borrowing rates remain elevated. And that's, as we've discussed here, as many Americans struggle with liquidity or emergency savings challenges. Is that just collateral damage or an unintended consequence because your tools are limited in addressing individual or household liquidity constraints, insufficient money in the bank?
Wow. What a guy.
I wouldn't agree that that's collateral damage of our I mean, over time we do what we do in order to create price stability and maximum employment, and those things are hugely valuable to all the people we serve. When we raise rates to bring inflation down, that does work by slowing the economy, but we've moved back our policy back down to where it's certainly not strongly restrictive at this point. I think it's sort of in the range of neutral. So that's what we're trying to do, and I would want people to understand that. I think what people are feeling is the effect of higher prices. There was a global wave, sort of every large economy in the world, sort of every large open economy, market-based economy in the world had a wave of inflation that looked an awful lot like ours. We actually came through better than any other country.
Slowed it down
substantially better.
significantly.
We had higher growth. We had better labor market. And this is really due to the American economy. We have an extraordinary economy, and people are innovative. They work hard, and so we're all of us who work in economics jobs are really fortunate to have the U.S. economy. So, thank you very much.
Thank you very much. What? He just killed the live. What a guy. Okay, so look, that is evident right there, ladies and gentlemen. Let's just bring this thing back up here, man. Get rid of that. And then we'll just mark this off here. Okay, so look, you see what happened there with Bitcoin? Look, this chart just proves it, right? This proves what I say to you all the time. I'm glad I've given it to you all in real time right now, okay? When price rises, they sell. When they stop selling, it comes down. Look, these guys here, they had offers at 74 million, so 72 million, okay, on the negative delta, 74 million, minus 74, all right? They sold spot, minus 74. After that, they sold spot, minus 82 million. After that, they sold spot, minus 78 million. And then minus 71 million. So these are traders selling Bitcoin as it's rising, okay? And then it just disappears. Look, those participants have done the damage by selling at the highest point. Now look at price. Look at shit. So when I say they sell when it rises, that's what's happened here. Now, if that doesn't sit in your mind, when you look at candlesticks, when they pump, they're preparing to dump. That right there is an example. Now, price can come down and the guys can start bidding again. Look, they're starting to step in and bid. If they can bid for it and then price marks up again, then we might get another wave of selling. That's how it goes up and down, okay? But this right here is a perfect example of it. Perfect example. Retail got squashed out, man. They sold into it. They were offering, the book was offering there. The book was there with the liquidity. They had it and they snap reversed. They just swept it all up there. Look at that. Look at all this Bitcoin. All that Bitcoin up there, taken, all right? And then the spot delta chart here just gives you the clue. It gives you the clue. That's all I'm saying. Okay? Well done, Tina the Frog. I know, but people need it, and people need it to be explained. Okay? That's what you've got to understand, ladies and gentlemen. Oh, XRP? Minus 1%. What a clown of an asset. Oh, God. NASDAQ, where are you? NASDAQ's clawing. Oh, it's all right. NASDAQ's doing okay. Legacy markets will be fine. Gold, yeah, pulling back a little bit, but Bitcoin might be prone to a little bit of volatility. Can easily come down again. But we want to see if those guys mean business. What you need to see happening now is you need to start seeing some bid volume coming in to show support, to hold price, to then effectively then trigger the next wave of selling to the upside. Okay? So when someone says Bitcoin's pumping, people are buying, no one is buying. They're selling. Anyways, never mind. I'm just a mad dude. Yeah, but listen, it doesn't... never mind. Yeah, you know what? Ladies and gentlemen, yeah, just don't worry about the voice. Anyways, listen, as I said before, if you are new, mad love. Make sure you're liking the stream on the way out. Thank you so much. You got 1,100 likes. Mad love to you. Anyone new, check out tradersreality.com on the website. New masterclass sessions are all available on there. And of course, trading BTCC, do it through TradingView. The description has got the link, and I've got the watch list straight after that as well, if you want to place trades through TradingView when you join BTCC. Other than that, ladies and gentlemen, forgive me with my voice. Mad love and respect. Platinum members, I'm going to get some flavor out to you to give you an insight into what we can expect going into Asia tonight. All right? Take care of yourselves, gang. I've got nothing but love for you, and I apologize sincerely. All right? Take care. How many times I got to say take care?